Good morning. Welcome to the XM.com weekly market update. And we're joined again by Peter McGuire, the CEO of XM, coming to us from Cyprus this week. Good morning, Peter.
Good morning, Andrew. Lovely to be here with you.
Excellent. Well, we'll get into the data again. Once again, we can start on the domestic front. The Australian CPI number came out last week, which did see a drop, not a significant drop, but it is still below, it is now below 7%. Heading down, which is what the RBA wants, but still a fairly high number.
Absolutely right, yes. And that was demonstrated, I think, by no rate hike in Aussie start of the month on Tuesday. So it's a good sign. Let's just see where it all rolls over this quarter with higher energy prices. So, yeah, it's a factor that we all take on board, Andrew, and it's a good sign for all consumers at the moment.
Yeah, and speaking of interest rates, as you said, the RBA kept the cash rate on hold yesterday, which was the first time in a long time. Now, there's a lot of speculation here. Are they done? Will there be a rate cut sort of right at the back end of this year? But I think it's way too early for that. There's still plenty of data coming out in the coming months, which could sway them either way.
Absolutely right. And I think that the similar mindset has crossed not only the Aussie as far as the RBA, but also the RBNZ. And I've just noticed on CNBC in the last matter of minutes, they've ramped it up 50 basis points in Kiwi. So, yes, maybe we're having a break, or maybe it's the end of that cycle, but time will tell. And I think 23 is going to be a fascinating year, my friend.
Yeah, it's there's just so many mixed signals, and I think that's what's troubling some of these central banks at the moment. But if we look at and a perfect example of that is the housing market. There's a fairly nasty chart there, but interestingly, in the Australian market, the building approvals year on year are down 31%, which is a massive drop off.
That's underpinning price, but the other side, where we've got a critical shortage, it's a tough time. And also the other part of the equation is funding from banks to try and start your development sites and so on. So, yeah, it's a tricky time for construction, and we'll just have to see again how 23 plays into that from the construction angle.
Yeah, very much so. Back on the CPI, Eurozone last week, they had quite a significant drop-off, actually. It was more than 1.5% drop month on month. So good news there. Is that sustainable or not is the big question. And we'll have to see what the ECB does later this month.
Well, exactly right. I mean, that was a good sign. And as you mentioned, it was a huge push down versus what we saw in the UK only a week earlier, where it was a big push up. So, yeah, it's mixed across that whole sector. I'm currently in Cyprus. I'm heading to Athens tomorrow. And it'll be interesting to see, how Greece is. And I'll be in Italy a little bit later. The domestic front across, the true essence of Eurozone and consumption and so on. So, yeah, it's a tricky time, but we didn't want to see what happened on Sunday come again as far as energy prices being pushed up, $6 or $7. It's quite crippling to consumers.
Yeah, it's certainly the last thing they want. US inflation as well, that's out next week again. It did come down last month, not a huge amount, but it is heading down. Obviously, they would like it to head down quite a bit faster, but interesting, you see what the RBA has done, what the RBNZ has done, and then the major economies will be following later this month. I'm sure they're looking at what's happening elsewhere to try and work out the best way forward for themselves.
Well, exactly right. The disconnect, if you refer to the Financial Times over the weekend, that was on front page, the disconnect between Riyadh and Washington and, the Biden administration and energy prices. So I think that that's going to be a core tenet of how this all plays as far as the inflation angle, Andrew. And, we sit here and just observe, but there's a lot of risk off. I see, where energy prices are, and certainly where COMEX gold, we got $2,040. So there's obviously a large sector of the market that are piling into gold at the moment.
Yeah, certainly is. GDP in the US last week was a solid number. Like, we look at the last couple of stats there, and that, I guess, is reflective of the labour market, which we'll touch on shortly. But the strong labour market has certainly helped the consumers hang in there, which in turn has given decent sort of GDP numbers.
Exactly. As we've discussed many times, if you want a job, you get a job, and that's the that's the angle that everyone's got. They've got, money in their pocket and wallet and purse, and they're spending, and that increases GDP. So it's a good sign in a lot of ways. Maybe not too good for inflation, but it's a good sign as far as growth. And, as we talk about NFP coming out later this week, non-farm payroll, it'll be interesting to hear that read as far as, jobs and so on.
Yeah. So no, it's a big number that I always look at. Interestingly, though, overnight, the US job openings number was quite a bit less than what the market had anticipated, which in turn saw a sell-off in the equities, and it also saw the lower rates on the 2 and the 10-year bonds.
Yeah, I've also noticed, a lot of the big downsizing as far as, major corporations across the US is in the tech sector primarily, and big layoffs, 15%. I think Salesforce was down about 12% of their workforce. Now, these are big clips and they're going in aggressively. No doubt management consultants are in there and saying, right, you're not hitting headline numbers, so let's cut staff. And that'll be, again, an interesting factor to look back by, say, August, how this next 3 to 4 months is going to play out.
Yeah, and we've spoken about a lot how resilient the housing markets have been in a lot of economies. So, and these, even though this is a lower number, it's still a lot of economies are close to full employment, but maybe this is the start of that weakening.
Yeah, well, time will tell, and it's as we say, 23 is going to be a fascinating one how it plays, and each quarter is, many traders were looking at is a continuation and a downdraft coming into that first quarter after Christmas, and it bounced, incredibly to the upside. So this quarter is going to be, how do we build on that first quarter? Where do we play? And time will tell.
Yeah, and we've got and US earnings start next week as well, first quarter earnings. So that's obviously going to have a huge impact on the market to see how these companies are actually performing from an earnings perspective.
Yeah, exactly. And then, your PEs and of course, we've got higher rates and, is there going to be a flood to money market? I think they've had about 340 billion has entered the money market in the last couple of months, quite simply because of, 4% sitting, on a banana chair.
Yeah, that's right. And talking of the interest rates, we've seen the 2s and the 10s in the US come off quite a bit again, but a lot of that was on the back of those job opening numbers last night. So, it's interesting. You only have to look back a month or so, or probably 6 weeks, to see that they were, it's close to 1.2% higher about 6 weeks ago. So there's certainly been a big move.
Yeah, absolutely. Yeah, that dictates traffic as far as currency trading. We've got that US dollar index at about 101.40, 101.50. We just mentioned what happened to gold. You've seen the bonds collapse. You've seen gold move up. It's just been an almighty trade. And let's see what happens again over the rest of this month. But there's plenty of volatility, Andrew.
Yeah, for sure. And finally, the oil prices, we've got the WTI and the Brent. They're probably a little bit higher than what this chart says. So as you said earlier on, there's certainly been plenty of movement in that oil market over the last couple of weeks.
Yeah, exactly right. And I think it hit everyone by surprise what happened Sunday. I was in Dubai. We did Bloomberg TV in the morning out of Sunday in Dubai on Bloomberg. And everything was a pretty rosy picture. Everyone thought OPEC plus we won't see any movement. It's just a handshaking sort of announcement. And they've come out and walloped the market and cut production by over 1.1 million barrels. And you saw what happened with Saudi, Iraq, Algeria, a number of other key players, Kazakhstan, and that's impacted oil prices. And we've seen a big push to the upside, and that's been very aggressive. We're now at nearly 85 plus for Brent, 81 for WTI, and that road to 100 could be achieved sometime, I'd say, next quarter. And that's going to be very damning if this continues to the upside.
Yeah, and as you said earlier, it's certainly will have an impact on those inflation numbers, which in turn brings higher interest rates back into play.
Yeah, exactly. So, I'm not here to speculate on rates, but it's just as a passive observer that it's just been incredible time for commodities and currencies, and certainly stocks over the last couple of weeks, or really since that savings bank fiasco out of Silicon Valley. It's start of March is going to be one to remember.
Yeah, yeah. It seems like years ago, that Silicon Valley.
Yeah, it does.
It's amazing. Yeah. It's amazing how quickly things change. But that's another good wrap, Pete. Thanks for joining us.
All right. I look forward to joining you next week. I'll be in Mumbai, India.
Excellent. Well, we'll chat again then, and we can catch up on all the data. And once again, that's the xm.com weekly market update.